They say, hey, look, if you just don't touch your money, client, we'll probably average you about 7% a year. Okay, but what happens is when there's turmoil and things happen and, we go to war or whatever, we're not going to talk about politics, but something happens and there's a shift or a liquidation event, the advisor, all they know how to do is pull this lever, and the lever goes risk off, and they go from equities to bonds. And then when there's a V-shaped recovery or there's some, growth, then they're like, oh crap, I missed the rebound, and they pull a lever and it goes back into equities. And so that's the strategy. And so when someone calls up their advisor and is like, hey man, I want to use some of my money for real estate. Number one, the advisor is going to say, you can't do that. What they need to finish the sentence with is, you can't do that with us, meaning the Fidelities of the world, the financial institutions of the world, the big banks, they just don't offer a self-directed retirement account. It's not because you can't use your money to self-direct it. It just means that the IRS, and I'm not going to bore everybody to death with the IRS code, but basically I'm going to sum it up. The IRS says, look, IRA custodians like the Fidelities or the big, financial institutions, they don't have to offer that tool to you as an option. And in the wording in the IRS code, it just says, due to hardships, meaning it's too difficult for them to do. And really what that means is they don't make any money off of you, by allowing you to self-direct your money. The IRS code just says these financial institutions just don't have to tell you that it's a thing, and they don't have to offer it to you as a tool.
If you're a real estate investor and are wondering how to raise and leverage private money to make more profit on every deal, then you're in the right place. On Raising Private Money, we'll speak with new and seasoned investors to dissect their deals and extract the best tips and strategies to help you get the money, because the money comes first. Now here's your host, Jay Conner.
What if the biggest risk to your retirement is not the market? It's giving up control. What if everything you've been told about safe investing is actually costing you millions of dollars? And what if the money you need to find your first or to fund your next deal is already sitting in retirement accounts just waiting for you to unlock the funding from someone's self-directed IRA account? Welcome to Raising Private Money. I'm Jay Conner, the Private Money Authority. And here's the truth. If you're still depending on banks, traditional lenders, or Wall Street to fund your deals, you're playing a game that you don't control. Today, I've got a guest who's going to flip that script. Carter Lane is the CEO and founding partner of Unified Wealth. And for over 20 years, he's been in the trenches, real estate, private investing, and building tax-advantaged wealth strategies that put you back in the driver's seat. After watching his own mother lose everything in the 2008 crash right before retirement, Carter made it his mission to make sure that that never happens to anyone else who is willing to learn from him. Since then, Carter's helped thousands of investors move over $100 million into self-directed retirement accounts, giving them the power to invest in what they actually understand, like real estate, private lending, and deals just like yours. So if you've ever wondered how to legally use retirement money to fund real estate deals, minimize taxes, and build real generational wealth without Wall Street, you're about to step into a master class. In just a moment, you're going to meet my guest today, Carter Lane, right after this. Carter, what in the world is the biggest lie that investors have been told about retirement accounts that's quietly keeping them broke or stuck?
Well, Jay, that's a loaded question because there's quite a few answers, but I'm going to keep it very simple. The lie that I was told, that my mother was told, is that Wall Street has your best interest in mind, and Wall Street, meaning the stock market or equities, is the only place for a person to place money to build for retirement. And that's just, unfortunately, for most people, they just don't know that that's not the truth. And so Wall Street is not, and we'll kind of get into this, I'm assuming we'll get into this, but Wall Street is not the avenue or the financial vehicle that is allowing people to retire these days. And so what we want to share with your folks today is that there is another option, and that is a self-directed option. So hopefully that answers your question. We can kind of maybe dive into some other pathways of why that's just not the case any longer.
Yeah. Well, not only is Wall Street not the only solution, when we're comparing Wall Street to self-directed IRA companies and someone having a self-directed IRA account, from my own experience, it's better than Wall Street. So let's dive into self-directed IRAs. I never heard of a self-directed IRA until February of 2009. From 2003 to 2009, as a real estate investor investing in single-family houses here in Eastern North Carolina, the only thing I need to do was go to the local bank or mortgage companies and borrow money traditionally from institutional lenders. And then after I was cut off from the banks abruptly in January of 2009, I learned about this world of private money, private lending, and self-directed IRA companies. So let's make sure the audience understands very, very clearly what in the world is a self-directed IRA company.
Sure. So let's kind of back up a little bit and let's talk about an IRA. So you've got the traditional retirement accounts, which is the IRA. And for those that maybe not know, that just stands for individual retirement account. And there's tons of financial institutions that offer those. Those are the Fidelities of the world. And then you have your corporate 401ks, and those are your jobs 401k plans. What a lot of folks don't understand is that in the 70s and early 80s, the self-directed version of these accounts came out. And companies like myself that understood the tax law and understood what the IRS says that we can do with retirement accounts, a self-directed retirement company like myself, we're a company that builds these tools. They're qualified retirement plans. It allows us to move an individual's money from a current or an existing retirement account like the IRA or the 401k. And it allows us to move those funds into a self-directed version of that, allowing the client to have full control of their retirement funds. And so to sum it up, Jay, a self-directed retirement company like mine builds these very unique tools and rolls clients' money into them so the client can invest that money into assets like we talked about before that they believe in, know, and trust, which is private money and real estate.
Now, I want to share with my audience that's listening to this episode as to why this episode is so critically important. Whether you are a real estate investor looking to invest in real estate, or you're already investing in real estate and you want funding for your deals, or you're an individual that has retirement funds already in place. Maybe it's a 401k from a previous employer. Maybe it's a retirement fund, with a stock brokerage such as, Edward D. Jones or Fidelity or Schwab or whatever. Well, as Carter just alluded to, you really are not in control. You're not in control of, they may say, they might give you a menu list of what you want to invest in, but contrast that to a self-directed IRA company, then pretty much, essentially, you can invest in anything you want to. You can use your retirement funds in a self-directed IRA to go invest in a single-family house, and the profit that you make on that is either tax deferred or tax free. If you are a individual and you've got retirement funds, you want to be a private lender. All this was brand new to me until 2009. The interest that the borrower, us real estate investors, pays you, that interest is either tax deferred or tax free. So the reason this is so critical, this episode is so important here with Carter, is that in my case, Carol Joy, my wife, and I, we've had 47 individuals funding our deals, our real estate deals, and over half of them are using their retirement funds that they have moved over to a self-directed IRA. That's why this is so important. Carter, most people think that their IRA or their 401k is safe, quote unquote safe. What are they actually giving up by letting someone else control it versus them having it in your company as a self-directed IRA to where they can control it?
Yeah, so we can just talk about that. And I'll keep this on a personal level, and you kind of talked about it in the intro, my mother thought her retirement funds were safe. She had saved almost $1 million in the 32 years at the one job that she had. All of that money was in her 401k because she was told that that money was safe. And that was the money, that was the vehicle that was going to allow her to retire. And on a Wednesday, with no influence or control of her own, she lost everything. So if we take a look at kind of the arc of a retirement account or the stock market, because that's where these traditional IRAs and 401ks are invested into, they're invested into the market. And so we have every 4 to 7 years, and based on whether it's COVID 2022, 2019, there are shifts in the market. And so the money that individuals have in these accounts, of no fault of their own, goes away. And so if we take a look at what is happening inside of accounts, and what a lot of folks don't realize is not only does it go up, it goes down, but the fees that are baked inside of these retirement accounts, and just for a sad little fact, over 63% of an individual's money in a retirement account, an IRA or a 401k, goes away in fees over the lifetime of that retirement account. So you have an institution, or you have a model that says, hey, look, client, let's give it's a 100% of your capital. You're going to take 100% of the risk. And over the lifespan of that investment account or that retirement account, you, the client, are only going to receive about 30% of the returns. And that's a rigged system in my belief, in my experience. And so are these accounts safe? No. I mean, we can take a look at what happened. And again, we're not going to get into politics, but tariff day, the market goes down 20 to 30%. Some people lost that. The unfortunate part is when those things happen, individuals, based on fear, because that is their money, they will sell at a loss. And so it's just this cyclical cycle that puts people in a bind. And so what you and I, Jay, want to talk about today, we want to educate people that there is another option. I'm not here to say 401ks and IRAs are bad. What I'm here to do is educate folks that there is an option, that if you're looking at, like Jay and I, we believe that real estate is the best investment in the world. I've been in real estate over 20 years. That's my personal belief and my personal experience. What we're here to do is educate people that if you're wanting to invest into something like real estate, or you want to be a private lender in Jay's deals or in other people's deals, you have the ability to control that money that's in Wall Street's control, put it in your own control, and invest into things that is going to make you the money without having to pay fees every 5 seconds. And that's just what those traditional accounts do. So are they safe? No, they're not. That's just kind of a long-winded, quick answer.
Carter, let's talk about from the perspective of a real estate investor that's investing in real estate. They're looking to borrow money, say from an individual or individuals that have a self-directed IRA account. How much money right now would you say is sitting on the sidelines right now that's available in retirement accounts that could be funding real estate deals? And part B to that question is, why aren't more real estate investors tapping into it?
Yeah, so if we take a look at, we're just talking about traditional retirement accounts right now. What is in retirement accounts?
Actually, I'm talking about self-directed IRA accounts that may have cash sitting there and they're looking to deploy it.
Well, we can do some simple math. So if we take a look at the traditional retirement landscape here in the U.S. is about a $7 trillion price point on what folks in the U.S. have in retirement accounts. And then we take a look at only 3% of that is self-directed. So whatever the math is of 3% of 7 trillion. So that is the money that is available. The 97% that's still in these traditional accounts, why are people not using them? It's a simple fact that just, unfortunately, we're just not educated. So Jay, you have the self-directed IRA was created in 1973, the exact same day that the IRA was created. The IRS put them both into law the same day. They both were written the same day. They both were put out into the public the same day. But unfortunately, you had Wall Street that took the flashlight and they signed it up, shining on this traditional retirement accounts and say, put your money into stocks or bonds or equities or mutual funds or all the things that benefits Wall Street. You have the 401k plan, early 80s was created, but the solo 401k was also created in the exact same day. And the solo 401k is a self-directed version of a 401k for a business owner. So again, to answer the question, it's just we're not being told that we can do these things. You know, the Fidelities, the Schwabs, the whomever, they're not calling up their clients and saying, hey guys, you know, we've been thinking over here at our financial company, you know, instead of just giving us all your money and instead of, you know, allowing us to fiat to death, why don't you control some of it in your own account, or better yet, control all of it? And then go invest in the real estate and you make all the profits and you control all the money and you don't pay any fees and you minimize your taxes. We're just not being told. And so that's why, conversations that you and I are having are so important for people, because I've been doing this for a very long time. And I'm going to keep it very current. I just got off the phone with a gal, 54 years old, tons of money in her retirement account, has 6 different degrees. And that conversation was the very first time that she heard that she could actually control her retirement funds for real estate. And her mind is blown and she's beating herself up. And like, I feel so stupid. I'm like, you have 6 degrees. You're not uneducated. It's just no one's taught you this strategy. And so, you know, that's what we're here to do, is educate people that there is another option for them if they choose it.
Carter, I think I know why people are not educated on this topic and don't even know about it. I believe they don't know about it because they look to their financial advisor, AKA their stockbroker, for their financial advice. There's zero commission. There's zero money in it for the financial advisor, AKA stockbroker, to even tell an individual about this option as having a self-directed IRA account. And all that's going to do is, if they tell them about it, and they go move part of their money to a self-directed IRA company, then the financial advisor just shot themselves in the foot.
Correct. And so to that point, so, you know, let's take a look at real estate, right? I'm a real estate guy. You're a real estate guy. Do you and I both believe that on a real estate transaction or investment, I can make more than 7% on my money?
Oh, my word, yes.
Oh, my word, yes. Correct. Do you know the average return on a 401k plan is over the lifetime? So let's take a 20-year lifetime, and we'll talk about a 401k. In that 20 years, a 401k on average does 5.6% a year.
Woo, doggies.
So if we're taking, you know, if we're talking to and I have these conversations with advisors all the time. Number one, they're uneducated on real estate. Bless their hearts. That's not what they're taught to do. They're taught to put your money into bonds and equities. That's what it is. So for those of you that are unaware, and I'm going to simplify this, most investment accounts, IRAs, 401ks, and they're pumping advisors out of these schools, and they're taught the same thing. And this is the thing. We're going to take your money. We're going to take the client's money. We're going to split it up into a 60-40 split. 60% of that money typically goes into a bond portfolio. 40% goes into some long-term stock portfolio, and they just ride it out. And they say, hey, look, if you just don't touch your money, client, we'll probably average you about 7% a year. Okay. But what happens is when there's turmoil and things happen and, you know, we go to war or whatever, we're not going to talk about politics, but something happens and there's a shift or a liquidation event, the advisor, all they know how to do is pull this lever, and the lever goes risk off, and they go from equities to bonds. And then when there's a V-shaped recovery or there's some, you know, growth, then they're like, oh crap, I missed the rebound. And they pull a lever and it goes back into equities. And so that's the strategy. And so when someone calls up their advisor and is like, hey man, like, you know, I want to use some of my money for real estate. Number one, the advisor is going to say, you can't do that. What they need to finish the sentence with is, you can't do that with us, meaning the Fidelities of the world, the financial institutions of the world, the big banks, they just don't offer a self-directed retirement account. It's not because you can't use your money to self-direct it. It just means that the IRS, and I'm not going to bore everybody to death with the IRS code, but basically I'm going to sum it up. The IRS says, look, IRA custodians like the Fidelities or the big, you know, financial institutions, they don't have to offer that tool to you as an option. And in the wording on the IRS code, it just says, due to hardships, meaning it's too difficult for them to do. And really what that means is they don't make any money off of you, by allowing you to self-direct your money. The IRS code just says these financial institutions just don't have to tell you that it's a thing, and they don't have to offer it to you as a tool. And so to that point, Jay, number one, people are not being educated. And unfortunately, or fortunately, however you want to view this point, but they have to go to someone like you first, right? They have to get themselves into a position where they say, look, I believe that real estate is the vehicle that is going to get me into the destination that I want to be, that I've always wanted to go. And so they have to go to a guy like you to get educated. And then a guy like you introduces them to a guy like me. And unfortunately, that's the model. I would love to go out and educate, every single person one by one. It's just, I'm connected with guys like you, and I'm connected with other high-level real estate guys. And unfortunately, they have to get educated to kind of get onto this assembly line to get moved into sometimes talking to a guy like me. So, back to that point, it's just people aren't educated for a number of reasons.
And what you just said is absolutely 100% true. Of those 47 private lenders that we have used to fund our real estate deals, of those 47, here's what's interesting, Carter. Not one of them, not one of the 47 had ever heard of self-directed IRA companies until I did what you just said. I put on my private money teacher hat and I educated them. Even beyond that, they had never even heard of private money or private lending.
Correct.
And then over half of them are using their, retirement funds to get high rates of return safely and securely. So Carter, break this down simply for my audience. How does an individual go from having a traditional IRA or a traditional 401k to actually using that money to fund deals, be a private lender, or to invest in real estate? What are the steps? How do they get it? How do they get it into a place that they can actually start doing that?
Well, we would love to talk to your folks about that. So here's how it works, right? There's kind of there's a two-part answer. One, an individual can go out and try to figure it out by themselves, right? You can call around there's a bunch of different companies that do a form of self-directed retirement accounts. You'll need to find out which one that you want, which one that your funds can go into. Anyway, so there's a bunch of different ways that you can kind of try to figure it out. I think the easy button, because I'm a cookies on the bottom shelf kind of guy, the easy button would be you can book a call with us and we can do it for you. So Jay knows this, and I'll just kind of educate everyone. Those of you that either have retirement funds that you're thinking about potentially using yourself for real estate and private money, or you have friends and family or other people that you're looking at, getting some investment capital from that have retirement funds. What makes us so unique in this space is we build self-directed retirement accounts that are attached to a bank account. So for all intents and purposes, without boring everybody to death with how the watch is built, our retirement accounts are a checking account at a bank. So if you have funds somewhere, and it doesn't matter where, we would roll those funds from that financial institution over into a checking account. So the money moves from stocks into cash into your own bank account. Because it's a bank account, you have access to your own funds. If you want to invest into something with Jay, you're going to wire him money. You're going to write him a check, or you're going to do an ACH into that particular deal. Once Jay pays you back, he wires money back into your self-directed checking account plus your return on your money. You don't pay a fee to do that. There's no taxes on that money because it grows tax-free. And like Jay said, there's some of these accounts that it is tax-free. So I think to answer your question, Jay, the simplest thing would be book a conversation with us, and we can educate you on what your account is and what it can go into and build you that subsequent account. And that money can roll into a checking account that you guys are able to use for whatever you want. Here's another fun little fact, Jay. In these self-directed accounts, the IRS says that a person can only not invest into two things, which means in our accounts that we build, a person cannot buy life insurance with it, and they're not able to invest into a collectible. Like the IRS doesn't allow you to buy stamps, coins, or alcohol for some weird reason. But anything else, any type of investing that you believe in, that you want to invest into, that's going to be good for your family, your legacy, building your wealth, these accounts that we create allow you to invest into any of those things. How can someone do it? I would say book a call with us, and Jay can give a ways for you guys to be able to do that, and we can educate you, and we can build these tools and roll it into a checking account for you.
Yeah, well, let's go ahead and dive into that, Carter. what's the best way for them to book a call with you and your team? Is there a phone number? Is there a website? How do they do that?
Yeah, so we have a URL link. So you can go to talktounified.com/J. And again, that's www.talktounified/J. It's going to come to a landing page. You can have some information on that landing page, but there's also a calendar link. And I told Jay that I'm going to personally make myself available. So for the folks that are going to be scheduling these calls, we will be having, whether it's an hour, hour and a half, if you want to do a Zoom call, a phone call, whatever you're the most comfortable with. But Jay and I come from the same camp where we want to make sure that we educate you on what your options are and then provide a solution if we can provide a solution for that.
Yeah. Thank you for making yourself personally available, Carter, because I know your time is limited and very precious. Again, that URL, the /J is JAY, my first name, but let me give out that URL again to book a call directly with Carter. And that's www.talk, T-A-L-K, talktounified, UNIFIED, talktounified.com/JAY. And of course, that URL is in the show notes. Carter, what would you say are some of maybe the biggest fears or misconceptions that people have about self-directed IRAs? And maybe which some of these misconceptions are just flat out wrong that you've heard people talk about or have concerns about?
There's a few. I think the misconception is, people feel that, well, number one, someone wants to, I would say one of the fears is, what if I don't know what I'm doing on the self-directed side? And again, to those of you that are watching, that's why, even myself go to guys like Jay to teach me things that I don't know. So once I have the education, once I understand kind of the game plan or the path forward, that fear goes away because you're having someone like Jay do it for you or teach you how to do it, right? So eliminating the fear and having a direct path of what you're going to be investing into. But I think one of the misconceptions would be, can I get myself into trouble with a self-directed account? Now, where that comes from, maybe some of you have looked at other self-directed companies. So in my experience, where that comes from, or the fear that's planted in individual's mind who wants to self-direct and basically checkbook control their own money, which is what we do. We build self-directed accounts with checkbook control. Your money is in your own checking account. So you're able to invest into whatever you want. You don't have to ask permission. You don't have to pay a fee, and there's no taxes on the growth. There are, however, other self-directed companies that are what's called a custodian. And how a custodian works is they will say, look, let's self-direct your money, which means the custodian will move your money from a Fidelity or financial institution, and they will move it into the custodian's control. So it moves from one Fidelity or wherever into the custodian's account. So now that custodian controls your money. And so when you want to use that money with the custodian, you have to ask permission. Typically it's filling out a form, submitting the form, the request saying, hey, this is where I want my money to go. Here's what I'm investing to. Here's why I'm doing it. And the custodian will take a look at that request, and then the custodian will send the money off for you, but they will charge you a fee for that. And then once you make the money will go back into the custodian's account, and there's another fee. So custodians are a fee-based business. And so what they try to do, again, this is my experience, what they try to do is try to put some doubt and some fear in an individual, like, hey, you don't want to control your money. It's super scary. Let us control it, because they want to make money off of fees. But to the point that I made a minute ago, the IRS says very simply, you can control your own retirement funds in your own self-directed account and invest into anything that you want except life insurance and a collectible, and be able to invest that money and don't pay fees and don't pay taxes. And so a misconception is you're going to get yourself in trouble. That's just not the case. I've been doing it over 20 years. It's not the case. It is a very simple account to use, and you're able to invest that money into what you want to invest that money into, without paying a fee and without paying a tax and without paying a penalty. And what was the other question, Jay? Misconception one, and then what was the other one?
Oh yeah, so it was so the misconceptions, and I'm glad you brought that up, Carter, because I mean that line of communication and conversation is out there. I mean, it's definitely out there that, you're going to get yourself in trouble if you got your own checkbook or whatever. And of course, you clearly laid out, what the IRS law says and what you can do. And so the second part of the question was, which ones are just flat out wrong? Well, you just identified that. That misconception is definitely just, flat out wrong. Now let's talk a little bit. Go ahead.
Just to that point really fast. So what would be flat out wrong also is you have a lot of individuals that will reach out to their financial institution and say, hey, I want to use some of my money for real estate. And the financial advisor will say, you can't do that. That's not right. They can do it. They just have to move it into a different account. They absolutely can control and self-direct their money. It just can't be in their account because that financial institution doesn't offer it. So that's another misconception or just a flat out lie.
Yes. Let's dive deep for a moment for the advanced high-level investors out there. What's maybe one strategy, maybe two strategies, one or two strategies that high-level investors are using with self-directed IRA accounts that maybe the average investor doesn't have any idea about?
Cool. Yeah. So let's jump into some more advanced stuff. So those of you that are already in real estate or any business for that matter, but we're going to use real estate because that's the subject that me and Jay are in right now, or the investment strategies. So for a real estate investor who's doing it as a business, meaning they have some type of business structure, and we're going to use an LLC as the example. So as Carter the guy doesn't invest into real estate. My businesses do. So those of you that have LLCs or S Corps or C Corps, but we use an LLC. If you're doing real estate in an LLC or a business, you guys are entitled to having a business's 401k plan, which is called a solo 401k. A solo 401k is a self-directed retirement account built the same way that I just explained it, which is a trust and a checking account. Your money's in a self-directed account. What a lot of folks don't know who are business owners or high-level real estate folks is that their businesses can contribute up to $72,000 to their solo 401k account per year. So I'm gonna kind of slow that down. If you're a business owner, whether you have a holding company, let's say it's in Wyoming that owns other LLCs that own property, all of those funds that those companies make can flow up. You can file a tax return after you minimize your taxes on the business side. And these are tax deductions that Jay and we're not going to dive into right now, but a business can have a bunch of deductions and write-offs, and we can depreciate a bunch of stuff. But when we file taxes on the business, if our business owes any taxes up to $72,000, well, instead of us just writing a check to the United States Treasury for money, we're going to take that money and we're going to contribute it to the business's 401k plan, which is the solo 401k. And since the solo 401k is a self-directed retirement account, it allows us to take that money and invest it into more real estate. So does that make sense, Jay? It's just this cyclical ecosystem that we get to build around ourselves as business owners who are doing real estate at a high level. It allows us to legally, morally, ethically minimize our taxes on our business by taking a chunk of that money and stick it into our business's 401k plan and then going and buying more real estate.
Who in the world would not rather pay themselves, investing themselves, than writing that same check to the IRS? So listen, if you are listening to this episode and you're a business owner and you are paying
any taxes,
if you're paying taxes and you're a business owner to the IRS, wouldn't you rather be paying a good portion of that to yourself in a solo 401k? If I just got your attention, if Carter just got your attention, be sure and book a call with Carter at www. And let me call out that URL again, that website, www.talktounified.com/JAY. And my land, start paying yourself instead of paying the IRS. Listen, what Carter just brought up right there, I'm so glad I asked the question. What Carter just brought up right there could be costing you hundreds of thousands of dollars a year, if not millions, over the life of you having your business. That right there, my friend, if you're listening to this show, was worth you getting up this morning. Carter, thank you so much for joining me here on the show. Again, to all the listeners, www.talktounified.com/J. Carter, thank you so much.
Thank you.
You got it. Now, listen, the name of this show is Raising Private Money. And if you're looking to raise private money for your real estate deals or raise more private money, one of the most common questions I get is, well, Jay, how do I even start conversations with a potential private lender for my real estate deals? Well, guess what? I've got a free gift for you. I recently wrote my Private Money $1 Million script collection, and you can get for free my very first script. It's how to start a conversation. It's called the Curiosity Opener. You can download that free gift at www.jayconner.com/scripts. Again, that's jayconner.com/scripts. And you'll be right on your way to talking money. Now, if this episode with Carter didn't change how you think about money, it probably changed what's possible for your future. Here's the truth. Most people hear something like this and do nothing. They'll go right back to letting someone else control their financial life. But you are not most people. So here's what I want you to do right now. Not tonight, not tomorrow, right now. I want you to think of just one person. Think of one person, one real estate investor, one business owner, one friend, one family member who is still playing small with their money and trusting the wrong system. Share this episode with them. Text it to them. Email it to them. Post it on your social media and say, you need to hear this. Put that with the post, because you're not just sharing a podcast. You might be helping someone take back control of their financial future. And listen, when you share this episode, you're not only helping them, you're helping us reach more people just like you who are ready to stop relying on banks and start raising private money the right way. And with this episode, paying yourself instead of the IRS. Be sure to subscribe, leave a review. Let me know your biggest takeaway from today's episode. And remember this, you don't need more money. You need more control. I'm Jay Conner, the Private Money Authority, and I'll see you right here on the next episode of Raising Private Money.
Are you feeling inspired by the knowledge you gained in this episode? Then head over to jayconner.com/moneyguide. That's jayconner.com/moneyguide and download your free guide that shares 7 reasons why private money will skyrocket your real estate investing business right now. Again, that's jayconner.com/moneyguide to get your free guide. We'll see you next time on Raising Private Money with Jay Conner.